Good morning. I'm sitting in the Isle of Man. It's Friday about 11:30 in the morning. I hope all our master investor friends are bunkered down safely and have plentiful supplies and are making the most of this difficult time. I know most of us will know someone who's had it, or indeed possibly someone who has succumbed to it in a bad way. And in my own case, my sister Claire, who works in the NHS, has had it and is now recovering. It's a pretty beastly thing, and she's still exhausted. But seeing 50 patients a day, as she was, means you're much more likely to be exposed to it than the rest of us who typically sit in front of computer screens and don't have so much social interaction. However, in my estimate, in the next 2 or 3 weeks, we'll have passed the peak in Europe and the UK. May still be on the ascendant in the United States, but generally speaking, if we look at the wave of this virus that's spread across the world, in Asia, there is absolutely distinctly a recovery. Then if you look at Italy, the number of new infections is, the growth of it is falling quickly. Spain seems to be improving, even though the pictures and images out of there are appalling. And here in the UK, the initial absolutely dire pronouncements about, people being in corridors in the hospitals and all this sort of stuff is probably not going to come true. And although the government's response has been mixed, generally, I would say it's been relatively good. There is no easy solution to this. But I would say that the COVID-19 ship has sailed, and as a biotech investor, the future is now combating the next one, the next pandemic, the next outbreak of some seriously threatening disease that will both affect us as human beings and crash our economy potentially again. So it's important that governments, and particularly here in the United Kingdom, take note of the relative costs of preparing for a future pandemic, now that we know what approximately the cost of this one is going to be, which is enormous, and build potential industries around fighting future pandemics, be they viral, as is COVID-19, or be they antimicrobial, which is another issue that the world needs to face, and which I'll address a little bit in this brief talk today. So Master Investor has been postponed. The show, which was due to go ahead last Saturday, has been postponed until December, and I'm pretty certain that by December we'll be more or less back to normal, and that this will be an exceptional show. Most of our exhibitors have indicated that they're going to carry on in December, and I think we will have a very good show. We have typically quite big or well-capitalized exhibitors at the Master Investor Show, which depends on sponsorship of that nature. And so I think that we will be able to put on an excellent show and a financially stable show, and we're really going to bring you the best speakers that we can, because by December the fog of war should have cleared, and we'll be in a better position to see what worked, what we possibly should have done, and to realign our portfolios for the future. Now, just very briefly, I would say that investors looking at their portfolios today, most of them will be sickened by what they see, including myself, with markets down around 30% in the developed world. The only one that's actually done relatively well is China, but of course China was affected by this last year. So, and the Chinese economy seems to be on the mend at the moment. But most people, who follow Master Investor will have had a difficult time. Compounding that, you've also got some of the, key dividend paying shares suspending or rolling forward their dividends, some at the direction of the government. In the case of the major banks, whether that's a good or a bad thing is not for me to discuss at the moment, but it's certainly affected share prices of these relevant companies. Because I think we will actually have a more or less V-shaped recovery, I suspect that this time next year we'll see these companies returning to dividend paying, and in many cases the cancellation or postponement of their dividends is actually going to help their balance sheets and help them to grow, and it's deferred income rather than lost income. So I don't think we should be too necessarily negative on that. At the moment, we're, about 2 and a bit weeks into the worst point of the crisis, where literally everything was being sold for effectively US dollars, since at that time the world had an enormous shortage of US dollars. There was a real scramble, and even my favorites, gold and silver, got hammered in that terrible crash because they represented an easy way of getting liquidity for investors who were being margin called on everything else. Gold and silver have since begun to recover, and particularly gold, which is not very far off the high of the year. And there's a good reason for that. That is because gold and silver are both hedges against instability and against rising prices. And although this appears to be a deflationary shock, we've seen the price of oil going down, we've seen mass layoffs, and we'll see more mass layoffs. And one would expect that inflation will moderate as a result. That will be a short-term phenomenon, because the creation of vast quantities of what in the old days would have been called QE, but now is outright monetary expansion. In fact, a sort of iteration of modern monetary theory is highly inflationary. And in a year or so's time, we'll see the beginnings of what will be a much bigger inflation than we've been used to in the last 20 or 30 years. That will have several effects. One is that interest rates will probably go up, not down. So we're probably at the bottom of the interest rate cycle, and that's a very bad position for bonds to be in. A year ago I talked about all these negative rate bonds. Well, there's a lot less of them, believe it or not, even despite this crisis around. But actual bond prices at the long end, in other words, the high duration or long duration bonds, look to me to be particularly vulnerable. We've already seen evidence of this in the so-called junk bond market, which has been very badly affected by this crisis, because the weak companies that have issued these bonds are probably not in a position to repay them in many cases, and particularly those that are related to the oil and gas sector in the United States. But other companies with shakier balance sheets will also find that their bonds are under significant pressure. And so that's not a place to be. And I wouldn't actually recommend sort of trying to buy bonds on the cheap now, unless you have a very specialist knowledge of that area. Because corporate balance sheets, which are linked to what you might call zombie or poorly performing companies, which have been kept afloat really by the interest rate environment, which has been very benign, are very susceptible to the deflationary shock that's occurred. And their bonds in particular will be very susceptible to the inflationary shock that we will be experiencing within 12 months to 18 months. So my general advice is to, unless you're a kind of professional short seller, is to avoid bonds, to avoid yielding instruments, be them from governments or from corporations, because actually equities, and particularly those of companies that are capable of producing strong dividends or producing a lot of cash, even if it's not paid out in dividends, represent much better value given the 30% odd fall across the board, and in some cases, much bigger falls. So if we want to step back a bit and think about our long-term investment strategy, as you may know, if you've read any of my stuff, I think you should divide your portfolio into two pots, really. One is, what is the long-term thematic opportunity for us as investors over a 10 or 20-year period? What are the great trends in the world that we should be embracing? Well, one is obviously climate change. And at Master Investor in December, I will be talking about opportunities in the climate change area. But what I would say is that the solar panel, wind farm, obvious investments are no longer particularly attractive because they have been well picked over by institutions, and they've become sort of rather boring quotidian investments that don't really represent great value for us as members of the master investor community. There are other areas, however, in the energy field, such as nuclear fusion and the sort of new areas of green energy that are interesting. And that's those that I'll be covering in my talk in December, and indeed possibly in the webinar that we're going to be hosting in a couple of weeks' time, which you'll be advised of, where people will be able to ask questions, and there'll be 2 or 3 of us as panelists on a master investor kind of virtual show, a slimmed down show for an hour or so in a couple of weeks' time. So energy is really important, and there is a huge shift going on, and there will be winners and losers in that area, but this is not what I want to talk about today. The 2 themes that I want to talk about today are, first of all, the juvenescence theme, the theme of longevity, because one thing that this coronavirus has exposed is the vulnerability of the elderly cohort. And by elderly, I mean people over 70, which is not that old in the context of people living, well into their 80s, 90s, and in many cases 100 now, and in the future, even higher than that. But they are vulnerable because their immune systems get compromised as they get older. One of the things that Juvenescence, the company, will be doing is working out a way in which immunoresilience can be improved in elderly patients. I think this is a much more exciting area than trying to jump on the COVID-19 bandwagon specifically, because there are already hundreds of trials underway for COVID-19. I'm pretty sure that one of the drugs, if not several of the drugs and vaccines, will be available in the relatively near future, and by that I mean within 9 months. So Johnson & Johnson is an example. They're talking about producing 1 billion vaccines by the beginning of next year. You've also got Gilead, which is a long-term favorite of mine, that's got remdesivir, which is an antiviral drug that seems to have promises in fairly late-stage trials. And there are lots of other things that you will have read about, some of which are fake news and some of which are very promising. So the COVID-19 shift from a commercial or preventative point of view has probably passed. And as we know, we're going to go into the summer months in Europe and America quite soon. And this virus doesn't seem to thrive very well in heat. And so I would expect, as with seasonal flus, that there will be an abatement. Possibly by the time that the summer comes to an end, we will have a vaccine, or we'll have something much more useful than we currently have. Now, this indicates basically this is not the Spanish flu. We're not going to get a second big resurgence and a second big hit to the economies, but it does mean that we've got to find ways of protecting the elderly part of the population, and that part of the population is growing in almost every country across the world. And Italy is a very good example of that. It has much an older profile than many other countries, or most other countries, and the same in Spain. And they have much stronger family alliances, and therefore it was much easier for the virus to spread between people because of their cultures. And hence they've had much more severe downturns and mortality rates than in other countries. But, you know, so COVID-19 is a ship that has sailed, just to reiterate that, but immunoresilience is an industry that really could be a very valuable one. And we, Juvenescence and other companies, British companies, are beginning to get engaged in presenting an anti-pandemic, both microbial, as I said earlier, and viral platform, so that for a relatively modest amount of money, the government and private initiatives can produce something that is world-beating, human helping, and anti-economic crash. And you know, the economics just stack up so wonderfully, because we've seen that, you know, there's trillions of dollars have been incinerated as a result of COVID-19. This can and will be prevented, and the accumulation of knowledge, scientific endeavor has been quite remarkable in this period, and it's partly because of scientific understanding, the sequencing of the genome, the ability to at least in theory, test people much better than they could in 1918, and social isolation, which they did not do in 1918. And as a result, I think we'll come through this relatively quickly, but we need to prepare for the next one. So healthcare, longevity are very key investments for the future. And I'm still, I would urge everyone to, you know, look for investments in that area, because this will not only be an investment play on increasing longevity, but if you are one of the people who lives a very long life, and there's a very good chance that you will be, because life expectancy is going to start rising again after this as a result of some of the drugs and discoveries that are not yet in wide circulation, then you'll need the money to sustain your life, especially since governments are going to be in no position to subvent all the elderly population with all the debt that they've taken on. And by the way, that debt that they've taken on, they will try and find a way of creating inflation to devalue it, which is another reason to be wary of bonds and to be long gold and silver. And the third area, of course, is related to the food supply, what we call agronomics, modern agricultural practices. Every one of these respiratory diseases has been passed by animals to human beings, some as a result of the intensive farming generally out of China, and some as a result of the wet markets that we've, you know, we are all familiar with, that have created the zoonosis, which is the transmission of animal diseases to humans, where the animals, for instance, in the case of bats, are resilient because they've had thousands or millions of years of building up immunity to these diseases. But when they get into humans, it's a bit like tuberculosis or typhoid in the early days when there was no resistance, or cholera. And the effects were devastating, as they have indeed been with COVID-19. So something has to be done about agricultural practices. We know that this agronomics ticks almost every single box of the zeitgeist of our times. It's positive for the environment. Animal farming is a huge component of global warming. It is positive for people who feel that intensive farming is cruel. The removal of intensive farming would mean that you wouldn't have billions of animals being slaughtered, sometimes in terrible ways, on an annual basis. The third thing is that it's really good for human health, because there's far too many antibiotics in the food chain, and it is estimated already that in Europe, 35,000 people a year are dying because of antibiotic resistance, which is partly, or in fact largely, due to farming practices, because 75 to 80% of all antibiotics are used in farm animals, partly as growth factors and partly to keep the rate of infection down because of the close proximity in which these animals are farmed. In almost every instance, clean meat, which is meat grown in laboratories, and the byproducts of meat, for instance, leather, dairy products, etc., can be produced and will be produced much more efficiently, environmentally friendly, with much less land use, much less water use, and obviously no cruelty. And the same goes for fish, and the same goes for the production of proteins, which are non-animal based, such as plant-based meats. This is going to be an unstoppable train. As yet, it's a little bit difficult to invest in it, which is why we set up the company Agronomics. Agronomics is now about £20 million in market value, but we hope to grow it significantly over the next 10 years to be a reflection of all the good stuff that's going on in this field. There are about 110 companies that we've identified in this field, and one of the things I'm doing with my downtime is writing a book called Agronomics, which I hope will come out in July of this year, which will be an investor's primer to this. So that's the first bucket, which is, the thematic investment. The second bucket is, what do you do today? Well, I think that there are 2 or 3 themes that investors should consider. One is that the US dollar, which was in very short supply a couple of weeks ago, because investors always scramble for dollars in moments of crisis. The response of the Fed and the Treasury has been to literally flood the US with effectively printed money, even though it's electronically produced. And that will lead to inflation, and it will lead eventually to a devaluation or debasement of the US currency. The US is not in a pretty economic state at the moment. It is estimated that the fiscal deficit there will be about 15% of GDP, and it's a very big GDP, as we all know. That entails massive amounts of treasury, bond, and bill issuance, some of which will be financed by the Fed, but ultimately, sending checks for 1,200 to most American adults, dealing with the costs of the slowdown at a time when the debt to GDP ratio was already high and US federal finances were under pressure, is going to be inflationary. And it's also going to mean that the US dollar, in my opinion, will be very vulnerable. And the hegemony of the US dollar over the last 10 years more is probably going to come to an end. So I would load up on currencies against the US dollar. The most obvious one is the British pound, which was heavily sold down when the margin calls were all coming in, but now is recovering. And I wouldn't be surprised to see my target of 135 against the US dollar by the end of this year being reached. As far as the euro is concerned, the behavior of the Europeans to the Italians in a moment of dire crisis wasn't very good. So it wouldn't be my currency of choice, but you could buy currencies from Asia. So the Singapore dollar, as an example, would be in my shopping list as well. I think the yen might go to below 100 against the US dollar. It's around 108 today. So that again represents an opportunity to buy. In terms of broad stock markets, Asia is recovering. I would buy the Japanese Nikkei index and leading Japanese companies. Toyota would be an example. Denso would be an example. And don't worry about the fact that the Olympics have been postponed, et cetera, et cetera. Japanese companies are cheap. Corporate governance is getting better. The dividend yields on Japanese companies will be far superior to those on Japanese bonds. And if the yen recovers, or doesn't recover, it goes up further, then I think that's an added bonus for investors in Japan. In the US, I was cautioning for the last year or so that you have to be very careful about the US market, but there will be pockets of opportunity now. Um, Dividend stocks with positive characteristics, I think, are interesting. Kraft Heinz has a yield of 4.5 to 5%. I think that's a interesting company to buy, especially since people have been stocking up on baked beans and tinned soups. You've also got the banks in the US, which are extremely well capitalized relative to where they were in 2008, have high dividend paying capacity in the case of the best ones. And the best ones I would include JP Morgan and Goldman Sachs. And there will be lots of M&A activity in the US as well over the next year or so. And these American quasi universal banks will be big beneficiaries of that. I think you could also buy the oil majors at the moment. BP and Shell in our part of the world are very interesting. ConocoPhillips in the United States. They make money at almost whatever price of oil because they are vertically integrated. They're capable of cutting capital expenditure at a time of shortening oil demand. And I think that they represent extremely good value and will pay decent dividend yields over the next year or so. I think Disney is probably a buy, and obviously it's been hit a bit by the closure of its parks, but they will reopen. People will forget, and then Disney's streaming service makes a very good alternative, particularly for families, to Netflix, and it's a much less highly valued enterprise than Netflix. In terms of the FANG stocks, one has to think that Amazon will continue to do well because it's very expensive as a company, but in this period of difficulty, it has managed to fulfill orders, unlike, for instance, Ocado in the UK, which, I think its reputation would be badly damaged because it just hasn't been able to fulfill any orders when the major supermarkets have done relatively well. And so, you might want to think about in our own market, Tesco, it's a good company. And in the United States, Costco, which seems to me to be an exemplar of a company in terms of retail distribution. In our own country, Pets at Home has been doing extremely well, and it's been open during this period, as indeed have pharmacies. And so Walgreens Boot Alliance, which has a good dividend yield, is another one for you to consider. In healthcare, AbbVie is a name that I like very much. It's got a dividend yield. It's a very well-run company. And then you've also, of course, got Gilead, which is a long-term favorite. And is probably the only stock that I know of that has not suffered in this downturn, with the exception of Zoom, which is the video conferencing thing that I'm on at the moment. I never even heard of it before this thing started. And then a company that my partners and I started or funded 5 years ago, called Biohaven, has now got its migraine drug on the market. It's got about $500 million of cash as of the last report, and market valuation of about $1.5 billion. Its drug is a migraine drug, and it just was launched on the US market. It's not a great time to be launching it. However, this drug really works, and there are plenty of people out there with migraine, and to my mind, this is an exceptional opportunity to pick up. I'm not on the boards, I don't have any inside edge on this, but I would say that it's a cheap company relative to its prospects. And surely at some stage, someone will want to buy a company with an approved drug for a huge unmet need and indication with a relatively small price tag per monthly dosage. So I like that one. And then you've got some of the banks here in the UK which have foregone dividends, but that's not because they couldn't pay them. It's because of government pressure. But next year they will be paying their dividends, and indeed they may find ways of paying out a bit more. So I think Lloyds Bank is the best of the European banks by far, in the sense that it's entirely UK domestic. It's very well run. It's got a prospective dividend yield of over 8%. Why would you put your money on deposit in Lloyds when you could realize both the capital gain and a very good and attractive prospective dividend yield? And of course, their capital ratios of these banks improves because they're not paying out their dividends. and therefore they're significantly better capitalized by a country mile than what they were in 2008. So I would gradually buy into the stocks that I just mentioned. And by gradually, I mean over the next month or two. If you leave it for too long, you'll have missed the bottom, because there will be a snapback rally. Many people are saying that, for a bear market to finish, we have to retest the lows. Well, in some cases, we have retested the lows. And there may be a further jolt downwards, but generally speaking, I think the combination of a huge influx of easy money, if you want to put it that way, coupled with the fact that this, in my opinion, COVID-19 will be over relatively quickly, coupled with insatiable demand for healthcare, which is my favorite sector by far, and shows no way of slowing down, because everyone is now very concerned about their health if they weren't before. Coupled with the opportunities that are emerging in agriculture, provides plenty of food for thought, to coin a phrase related to food, for investors, and plenty of opportunity. If you've got caught short and you don't have any or much cash, then the clear, obvious thing to do is to have gold and silver in your portfolio. So my target on gold is over $1,900 by the end of this year, and over $25 on silver, and that remains a target that is intact. Silver is hovering under $15, gold's around $1,620. So both of those represent a potentially massive capital appreciation opportunity. They don't carry dividends, but on the other hand, cash doesn't carry any interest, or very little interest at the moment. So why would you not be long gold and silver? So that's the message from the bunker, the Claremont Hotel in Douglas, which is owned by us, and which has absolutely zero guests at the moment, but a full staffing complement. So if when it all gets better here, please come and visit the beautiful Isle of Man. And it's certainly been a pleasure to be here, because it is gorgeous. And the government here has taken immediate measures to dampen down the effect of coronavirus very successfully. So the Isle of Man will, I think, once again demonstrate its economic resilience post this. But I hope that you, wherever you are, and I guess we're all doing the same sort of things, trying to occupy our days and then watching box sets at night, are happy and healthy, and that you're not too badly affected by what's been going on. So have a great weekend, and thank you very much for listening.